We've got some great sessions today. We're going to kick off with a panel looking at commodities, what's hot and what's not. And to take you through this, we have Amy Rotman from One to One Group to introduce the speakers. So, Amy, if you'd like to join me on the stage. Here she comes. All right, Amy Rotman.
Hi, good morning, everyone. So I'd like to call our three panelists to the stage. We have Sophie Spartalis, Senior Research Equities Analyst, Metals and Mining at Bank of America Merrill Lynch. We have Paul McTaggart, Director, Pan-Asia Metals and Mining at Citi Research, and Vivek Dhar, Director, Mining and Energy Economist at Commonwealth Bank. All right, so this panel is going to be focusing all on the commodities outlook, winners and losers in 2020 and beyond. And so maybe we can start with Sophie, since you're sitting closest to me. Do you want to maybe take us through some of your top picks for the coming year?
Sure. So thank you for the opportunity to be speaking here today. In terms of 2020, we still like gold. Obviously, we've had a great run through 2019. We do expect it to sustain at around this $1,500 an ounce level for the next few years. That's obviously against a backdrop of very high geopolitical uncertainty and everything else that's going on around the world. So for us, we still like gold. And then that also flows into the equities as well. In terms of those metals that we're cautious around for 2020, it's aluminium. Obviously, we've had huge curtailments on the supply side. We've got Alcoa now, reviewing a significant amount of their global portfolio, and we think that it's really, the demand side's just lacking, particularly from the Western world. And then also copper. It's a tough one. It's very much dependent on the US-China trade deal. Look, we do believe that we'll get some kind of soft resolution to the deal. But the concern that I have around copper is, while the market is very bullish, optimistic on copper, I'm a little bit more sceptical on the supply side. I do see the major producers having the ability to bring on marginal or brownfield expansions. So I think that there is enough capacity in the existing asset base to bring on incremental supply, and that's not being factored into the market at the moment. I understand and I agree that the new greenfield projects will be lacking, and that's obviously forming the market's view around a positive outlook for copper. But I do think that, as I said, the underestimated factor here in the whole copper story is the ability for particularly the major miners to bring on incremental supply.
Great, thanks. And Paul, do you want to give us some of your top picks?
Okay, so I think I'd frame it firstly by just thinking about the macro backdrop for a moment. So it seems that today central banks are probably behind the curve in terms of growth. Growth is slowing, so we're seeing central banks dropping interest rates, trying to pump prime the economy again. And the bulls would say, okay, now it's time to get on board. We can see that loosening policy will ultimately result in improved growth, and that's probably true. But there's a lag there, and the lags often take longer than you think. So my sense is, in terms of demand scenario for commodities, first half next year is going to be quite weak, and then second half should start to improve as we get a response to monetary stimulus. If you think about that as a backdrop, it's going to be difficult for iron ore in the first half of next year. Chinese steel production's holding up pretty strongly. We're probably going to finish, up 6%, 6.5% year to date. But into next year, it's pretty clear that property starts in China are slowing. So, there's going to be generally weaker property demand for steel in 2020. The offset might be better infrastructure demand, but probably the best we can hope for is flat steel production in China. But world ex-China will be certainly weaker in the first half of next year, and we know already that September September data showed that consumption in world ex-China was down 3.6% year on year, and accelerating a downtrend that started probably 4 months ago. So that would make me cautious about iron ore. So iron ore has already given up some. So the question is, okay, we're at low 80s now. Where do we go from here? It's possible that through that first half of next year we're going to get back down to it's possible that we maybe even get back into the 60s, high 60s. In terms of other bulk commodities, though, I'd feel more constructive about met coal, simply because today's met coal price is at a point, roughly 135, where we're starting to see US production come out of the market. So the US is a swing producer in both met coal and thermal. So they're kind of a natural balancing item. And really, what's mucked up met coal is the Chinese import quotas, which affect both thermal and met. But effectively, it's been, sell or no buy for really the last month or so, while the Chinese have been out of the market because the quotas are now full, the import quotas. So you've got to wait until the new year to kind of roll over into the calendar 20 import quotas. There's clearly a big price differential between Australian met coal and Chinese domestic met coal. So once those new quotas are accessible, I'd expect to see, strong demand for Australian met coal, at least until that arb starts to close materially. So I think there's upside for met coal from current levels. The other commodity, I wouldn't disagree with Sophie about aluminium, but in terms of alumina. So aluminium, I was in China maybe 6 weeks ago. Aluminium producers are making money even at today's crappy prices because costs of production have come down quite a bit, both in terms of energy inputs, caustic for alumina. Alumina prices have come back. So they're still making a margin, 100 to 150 a tonne, even at today's bad prices. So the bad news is for aluminium that, expansions in China continue. And you can kind of see that we can continue to have probably, at least in the near term, a surplus in the alumina market. The good news for that is, of course, you need alumina to feed it. And with current alumina prices, we are biting into the China alumina cost curve. And, we're probably going to start to see from here a deferment of some of the refinery expansions. And you're already getting news of that coming through. So, the general view in China amongst the alumina producers is they're constructive on certainly alumina prices can move up. Whether we get our house view is we get back to 340, 350 next year. Maybe not, maybe we won't get to that level, but I can certainly see us back at mid 330s. And currently we're about 278, so decent upside on alumina. As a house, we're gold bulls as well, and that's really around a view that a trade deal doesn't get done, which is not actually the Central House view. The Central House view is that the trade deal gets done, but the commodity team thinks there's risk around that. They think that we see a further reduction in interest rates, to my earlier point, and that we end up potentially at negative real interest rates in most of the global economies, and that gold, in a negative interest rate environment will be a well-sought-after asset because it's like a zero coupon bond, if you think of it that way. So we see upside to maybe 1750 from current levels. So that's the house view. I'm not sure I'm convinced on that, to be honest, but that's the kind of house view. And that's a good place to stop. So positive on alumina, met coal, cautious on iron ore. I didn't mention zinc. We are quite cautious on zinc as a base metal. Too much new supply. And, modestly constructive on gold from current levels.
Sure. So that's a hard act to follow. Look, in terms of what we're looking at CBA, I'd say probably nickel is where we lack the fundamentals, and we know a lot of that has been priced in already, but we see more upside to that. And really what's driving that is right now supply side constraints. And then that's coming out of Indonesia, and we see about 10% of global supply at risk. At the end of the day, that's going to wash through to be a smaller amount, but we see that as a big driver of nickel right now. But really, nickel is really leveraged to that battery boom. And it's not just that singular argument of an exponential lift because of EV uptake. It's the increasing nickel intensity in batteries. And so for us, that's really where we think nickel has a lot of upside room over the next 5 years. So we're quite positive on nickel in that. It's gold. It's funny. I've heard 2 positive gold views. We're also positive, and we're 1700. announced midway through next year, and we're actually factoring another 3 rate cuts in the US. And for us, that's really where the driver is. For us, the strongest correlation when it comes to gold is how long-term US real rates track with gold prices, and what we've seen is that tends to track downwards in a rate cut cycle. So that's certainly a big driver for us, and that's one of the commodities that we like. Look, with copper, we're not super bulls. We're actually quite conservative. We're at $3 a pound in about 3 years, and that's a very gradual incline there. We think with copper, there's a tendency to trade at the incentive pricing level, which we are very cautious of. That, for us, is something which is temporary, and you need it for a little bit, but what we've seen is supply has responded initially. Just backing what Sophia said, for us, though, there is a closing window where if we don't see greenfield projects come through, we do get a supply gap by 2030. And that's something that is on our mind and something we're paying very close attention to. But just to round out the negatives, I think it was summed up really well. For us, iron ore is one that we're quite pessimistic on. We see a lot of downside risk coming into next year, particularly with how supply impulse is evolving. We are seeing a lot of seaborne supply make its way as Vale comes back. On top of that, BHP Rio, we are seeing that supply come on in 2020. And with steel basically flat, if not slightly up next year, it doesn't look good for iron ore. So that rounds out our probably favorites and worst.
Okay.
If I can just maybe add as
sure.
well, is one thing that's quite different today versus a few years ago is these commodities aren't trading on, fundamentals, demand, supply, outlooks, that sort of analysis has had to be put to one side. And, every day we're waking up to, governments changing their decisions, i.e., in the Indonesians on nickel, etc. So I think that with commodities, it's probably more difficult than ever now to predict where prices are going. And we do have to navigate through the geopolitical uncertainties, which is basically a new era for us. And also, we're waking up also to, companies coming out and reviewing, as I mentioned before, in terms of the aluminium supply for Alcoa. Chalco also came out overnight saying that they're reviewing 30 to 50% of their alumina capacity. That's 2 to 3 million tonnes that they can take out, and they're saying that's because of market concerns and environmental concerns. So, it's always a moving target, and I think that 2020 will be no different.
Yeah, absolutely. I think moving on, before this panel, we had a quick discussion about some of the other kind of hot metals that are currently kind of up for discussion a lot these days. Sophie, I don't know if you wanted to talk a bit about kind of the rare earths and what you see happening in that space.
Yeah, I guess rare earths was one of the biggest beneficiaries in regards to the US-China trade talks earlier this year, and Lynas is probably the pin-up child for here in Australia. And I think it was quite interesting in that, what people underestimated at the beginning of these US-China talks was around, the impacts to the commodities and rare earths. I learnt a lot by, speaking with Lynas in regards to Australia is in a very optimal position. We do really hold the key to, I guess, bridging the alliance with America, and they're obviously very tied to Japan. So, again, we're getting increasing geopolitical influence in the commodity markets.
Look, I would back that up in terms of what we're seeing. That the rare earths was really a pinch point that China could target in that relationship, and that's something that the pressure they could put on the US supply chain. And so I think that's where China was really putting their focus. So for us, that's something that we saw happen, and Australia, like rare earths is one example, but there's plenty more where Australia has actually responded positively to the US-China trade war. Because it sits as such a resource-heavy country.
But I think also what's happened is we've seen as China's industrialised, the globe has pushed more and more production into into China. So we've kind of got ourselves in our own little hotspot here, because that's exactly what's happened with batteries. Is, you know, China has had the ability to generate all this IP over the last decade, and the US has really been lagging on that, and now they got themselves into a position where they either have to spend a significant amount of capital to try and catch up, but then there's obviously skepticism as to whether they can actually do that. And so because, you know, as China was growing, you know, a lot of Western world companies were transferring production into China. And then this is what's got us into the bother we have today.
Looking at the batteries, we had a discussion late yesterday about kind of some of the key battery metals. Do you want to give any thoughts on kind of where you see some of those resources going?
So it's
Lithium.
That's a good segue, because I do have some of the lithium names under my coverage. So look, I'm quite a bull around battery technology, and as much as anything, you know, because car makers are self-serving. So let's not kid ourselves that, you know, they're out there being sort of wonderfully environmental. The reality is there's about 60% less moving parts in an EV car than there is in a conventional internal combustion engine. So as much as anything, it's lower manufacturing costs that will want to drive car manufacturers to be EV driven. I mean, that's the fundament. I mean, that's kind of the basic driver. So, you know, let's start from that perspective. So if you think about nickel, you know, so I still cover some nickel stocks, and I've done some nickel work for other corporates. You know, depending on your view on how you think EV take-up rolls out, anywhere between potentially sort of 5 to 800,000 tonnes of incremental nickel demand over the period to sort of 2030, you know, which is substantial in a, you know, what is sort of a 2 million tonne market. So, you know, clearly I think longer run, there's a positive thematic for nickel. The trouble is for lithium carbonate, you know, let's start that as the raw material. Well, obviously it just got overhyped, and we brought too much production to the market too quickly, and particularly here in Australia with spodumene. So, you know, the barriers to entry aren't high. It's not like iron ore where you have massive infrastructure requirements, port and rail, etc. There are massive capital barriers to iron ore, and even though we're all a bit bearish on near-term iron ore prices, you can see the issue for carbonate. For China itself, so this year EV car production will be sort of 12-13 million tonne units. The target under their current 5-year plan for next year is 20 million. And when I was in China recently, you know, there was a firm view amongst battery manufacturers that China was very keen to meet that target. And, you know, the only way it can easily meet the target through legislation. So, you know, you basically say your government fleets need to be EV driven or whatever, and you quickly meet your target. So I don't think there's really an issue around the demand side. It's just we need to deal with the supply side. And of course we're taking lots of pain now. We're seeing spodumene producers pull back production. You know, I think that will continue for a while. I'm certainly not bullish on lithium carbonate prices near term. You probably need to wait. And if you're buying an equity, I mean, the one stock that we are positive on is Orocobre, simply because it's self-funded and it's already in production. So if you're a junior going through that startup phase, you're going to be in plenty of... it won't be easy for the next 12 or 18 months as you need to meet your debt requirements, you run at lower production levels, etc. You know, it's going to be an awkward phase. So hence, you know, the only stock that would be positive on in the space would be Orocobre, because it's been through all that already and sort of come out the other side ahead of the current downturn on price. But we're not looking for any immediate recovery in LCE prices. I think that's still probably 18 months, 2 years away.
Mm.
Sure. So with nickel, I guess for us, where the positivity comes is actually more on what's developing on the supply side and what needs to be developed. Right now, your way into batteries for Class 1 nickel is really through your sulfide deposits. But because laterites make up bulk of supply right now of resources, you eventually have to master the HPAL. And that's the high pressure acid leaching. Now that's where there are a lot of risks. And I think the model that China is really trying to follow is what in Ramu and PNG. but you look further into the details, even Ramu had problems, at least in the last few months. So you're now looking more broadly, and Indonesia is really the flashpoint. A lot of investment in Indo, and really the HPALs there will make or break what long-run price we're going to set for nickel. And I think that's really where the optimism is. So it's not just a demand story, which is leveraged on two key fundamentals. The supply side has some big structural constraints. And so that's where the nickel positivity is really coming from. On lithium, look, the remaining, like lithium, cobalt, graphite, when we talk about this space, these all really emerged out of batteries itself. Nickel at least was mature. Of all the three, if I had to fundamentally look at it, lithium has to do the most legwork to increase supply to a point where they're meeting market demand in 10 years' time. And for that reason alone, fundamentally, lithium is our preferred of the remaining three. Cobalt has massive demand pressures because even though we're seeing EV uptake, cobalt intensity is falling, right? So that's a big risk when we talk about cobalt. And graphite really faces risks on how we're going to evolve the anode. Because the next stage of technology, once we go past like NMCs, your nickel manganese cobalt batteries, or your nickel cobalt aluminium batteries, is your solid states. And solid states is almost lithium metal. And so once we reach that point, these are the real positive risks when we talk about lithium in the longer term. But graphite really faces that risk on the anode as the technology evolves. So that would be how I see it. Nickel 1, lithium 2, and I'd be reluctant to, like, cobalt looks much better than graphite, but I'd still be cautious.
Great. So we've talked a bit about kind of the U.S.-China trade war. Just wanted to kind of expand on that, looking at kind of how the threats of these different geopolitical factors are creating different supply-side opportunities. I'm not sure if, Vivek, do you want to start?
Sure. So when you look through supply chains, that's probably where you're going to have to look at, and really where we've seen the risks with geopolitical. It's probably been a little out of, say, US-China. I think US-China was really rare earths, which really came out as the main topic of concern. But you're looking at that metal space. I think it was like copper has seen a lot of supply disruption generally, and we're talking on average in the last 10 years, concentrate supply, maybe 5.5% to 6% of global concentrate supply has fallen out of initial expectations every year. So that's been the flashpoint, and this year has been no different. And what we've noticed though is that the U.S.-China trade war, the effect it's had is that it's overpowered supply disruptions. It's almost like unless the supply is a permanent disruption, we will not see an impact on pricing. And we saw it with copper. We saw it most recently when we saw the protests in Chile. We saw prices come back very quickly, and in oil we saw it. We saw it with Saudi Arabia when the oil infrastructure was attacked. We saw prices come back within 3 weeks. So in terms of what we're seeing, we need to see something more to change the price, and that's really the impact of the US-China trade war in terms of driving that demand story, which is very strong near term for pricing right now.
So I guess my observation is that, the mining sector's always lived with geopolitical risk. You can think of Chile opening up. BHP went into Chile with Escondida in the late 80s, not long after sort of restoration of democracy. Increasingly, we're going to have to see mining companies go to the riskier geopolitical areas. That's just a reality. So mining companies now, the big mining companies, are struggling with growth, so they're kind of ex-growth. If you want to find growth, and if you think of BHP, which has defined itself some years as, it's focused its investment on OECD countries because it wanted to minimise risk. Well, that's great, but, you really got limited opportunities now in Chile to go much larger. We haven't talked around ESG. That's a whole new topic, but the sad reality is water. Most mining operations use water-based separation processes, and so the mining industry is a massive consumer of water, and that's going to be an increasingly difficult point going forward. So if you think of the mining companies, Rio Tinto decided it wanted to take more risk, has put a whole bunch of money into Mongolia. That hasn't worked on two levels, both geopolitically and technically. So that's a salutary reminder for how awkward it can be in going places like that. I mean, Glencore is muddled around through the DRC. That hasn't been an entirely happy experience either. So increasingly, the world will have to think about where we invest in the future. Increasingly, it's going to the next deposits will be in difficult jurisdictions, and we have to think about how to manage that risk. BHP's push is to say, okay, we're going to do oil, and that's in sort of OECD jurisdictions. But for other mining companies who don't have an oil outlet, it's quite a challenge, and it's a challenge that's getting more difficult, not easier.
Mm-hmm. Sophie? Okay, great. And so one of the kind of last topics that we wanted to cover is looking at different sectors where Australia's geology and political landscape can give domestic miners a competitive advantage. So, Sophie, I don't know if you want to start us off there.
Yeah, look, I think there are countless examples of this. Let's firstly start with the Bowen Basin hard coking coal. In terms of the quality, the scale, you certainly have cost efficiencies coming through, and the ability to also have a deep water port there, and then the rail line. So, as I said, you've got hard coking coal in the Bowen Basin. You've even got our thermal deposits, in terms of the quality factors in the Hunter Valley. You then come around, you've got our zircon deposits in terms of mineral sands. Those zircon grades are one of the best in the world. And then you've obviously got nickel sulfides in WA. We heard a lot about Indonesia today and the Philippines, but, really the nickel sulfide grades that we have in WA, which a lot of our junior companies are the owners of those assets, certainly gives them the competitive advantage, particularly as they now enter this battery world era. And then you go north into the Pilbara and the iron ore mines. So, again, grade, we are blessed with grade here in Australia. We're also blessed with our coastline and our location to Asia, which has been, basically has had an insatiable appetite for commodities for a decade and a little bit over. So I think we are truly blessed here in Australia in terms of what we can offer the world.
Paul?
I think that's broadly true. Iron ore is an interesting one. So at the moment, you've got Fortescue, bidding on some leases in Guinea. Guinea's been a great hotspot of investment for China, for example. So much of China's alumina expansion, which is obviously feeding its aluminium industry, has really been on the back of a massive expansion of bauxite out of Guinea. Now, bauxite is relatively easy to mine. It's usually not much cover. It's in small ships, etc. There's not that massive infrastructure spend that iron ore requires. But now you've got, Fortescue sniffing around in Guinea. Whether they'll ever do anything there or even win the current round of lease auctions, who knows. But the Australian producers probably need to think about the dynamic in the iron ore market. The last thing you would want would be China investing heavily into Guinea to build a large-scale iron ore export industry. And in fact, the cheapest expansion tonnes for the iron ore industry are in Australia. You can think of Rio Tinto, who operates 2 ports. It's relatively cheap for Rio Tinto to expand. Whether they would want to or not, given the value over volume kind of thesis, who knows. But definitely I think Australia in some of those key commodities needs to keep an eye out for Chinese investment that might go into other jurisdictions like West Africa, in commodities like iron ore, which are kind of our bread and butter in terms of the iron ore, the export earnings for the country.
Great. Vivek?
With Australia's advantage, for me that analysis is, okay, where do Australian assets sit on the cost curve across different commodities? And really, the ones which stand out for Australia's benefit would be iron ore and alumina, particularly in Western Australia with the high-quality bauxite, the low reactive element. So those are the 2 key advantages I'd say Australia has. it's interesting hearing the comments on iron ore. I think some of the reluctance to invest in iron ore in the longer term is more to do with the fact that there's so much uncertainty with where demand will go. Even if we see expansions in Australia, I'm worried that if China moves towards a higher scrap steel usage in their steel sector, that pure iron ore demand that you're looking for is going to be caught out. And if China chooses to invest in Guinea, even if it's coming from elsewhere, my concern is simply they're going to do that for security of supply reasons, maybe not for economic reasons. And that's something you have to keep an eye out for. Some of the biggest investments that we've seen around the market have been Chinese, particularly in this space, and even Indians are getting involved. So that's something that has become striking. Is you just got to see where that supply security meets that economic incentive argument, and what do the majors here and the producers here think about that?
I think also we have, here in Australia, we have a very stable political environment. We've certainly learnt our lesson over the last few years when we try to introduce the MRIT, that that's not a good thing. And so you're seeing increasingly, governments trying to engage. Like, for example, in WA, that gold royalty is now dead, or the hike in the gold royalty is now dead in WA. And then you've also got, look at Queensland, for example, with their approval of the Adani project, the big major permit that came through. So, we are certainly trying to incentivise further investment here in Australia. But I agree with the other panellists in terms of the quality. It does certainly provide a cost advantage for us.
Great. So at this point, I just want to see if we have any questions or comments from the floor for our panelists. Yeah, sure. So, can get you a microphone.
He's got a big voice. Just on iron ore in particular, part of the price spike was related to the disruption in the tragedy in Brazil. How do you see that Brazilian supply stabling out over the next few years?
I'll answer this first. Look, in terms of Vale's production, over the next 2 years, we see that normalizing. So we're putting a 24-month, and most of that is loaded into 2020. With a smaller component in 2021, and that's to plan. I think when you look at Vale's reports, you tend to try and be like, are they too ambitious? But constantly we're seeing them adjust and do things which for us make us believe that, look, they are actually serious. And their approach has been sensible. They've looked to do dry processing first and then move to wet processing. And that's what they've left for the end, because that's the one that will take the most in terms of compliance hurdles to get through. So in terms of how they're doing it, it certainly looks like that supply is coming back. And the positivity we saw when Brusutu came on, which meant they had some level of traction with dealing with compliance issues there. So far, like that looks like a 2-year story. 2021, by the end of 2021, we think that will be back to normal.
So, I mean, we as a house have the same view. We've kind of assumed, 2 years from now, it's full production's back online. But they have twice already reduced this year's guidance. So, I mean, you probably say there's some risk to the downside on that. I think the other wild card for iron ore, we haven't really talked about it today, would be India. So India's in the process of, basically everyone has to auctioning all the iron ore leases off, and everyone has to reapply. And what we observed in the coal industry was that basically disrupted production, and India never made its production targets in coal. So there's quite a lot of talk in India at the moment. Pressure on the government to make sure they don't muck this up, and because if they get it wrong and iron ore production is impacted, India might suddenly go from being a modest exporter to potentially a 50 million tonne importer. So, there's always wild cards in all supply sides. It's certainly not anyone's central case that India will muck it up. But, in the past, there's a bit of a track record to suggest that they might not get this right. And so it may not be an easy transition. and then ultimately, we see kind of a supply problem within India.
Great. Do we have any other questions from the audience? All right, great. Well, that pretty much wraps it up for us today. Can we just give the panelists a big round of applause?